Good afternoon, and thank you for tuning in here to our first daily report video of the Super Growth Multibaggers. Uh, I'm convinced this is the way to go. It's a lot easier to explain what I'm doing with charts and by describing it verbally than it is in words, even though I'm a writer and I've published several books, but the uh, these daily videos are going to get a lot better. They're not great right now, I know. I've actually tried to record this 54 times in the last 24 hours, and this one isn't going to be great either, but it's a start, and you have to start somewhere. So let's start with where the market is right now, and we'll take a quick look here. Market up almost, it's up almost 1% today, so it's continued upward trend. And as before, when it slips below the moving average here, it's a buy. And that happened 5 days ago. And the market's continuing on its somewhat celebratory track. It says, whoopee, low interest rates, buy stocks. I'll tell you, sometimes I look at it and I think, man, this is unreal, but it is. Okay, so we'll start with current, let's start with stocks closest to their indicated buy at price. And I guess I'm unable on this thing to, let's see if I can do it another way. Yeah, okay, there we go. All right, Bio-Rad, the company closest to its indicated buy at price, 7.7% above. Now indicated buy at 524. We have a position. We purchased that position at I know we're losing money on it, but 586. So we're down here by it's 2.4% of our portfolio, and we're underwater by 3.69%. And we're very happy to buy more of this company should it fall to 524, and currently trading at the position was purchased at 586.16. So as you can see here on the chart, we purchased after a fairly rapid decline, and the decline has slowed, but it's continued, and we're waiting for an opportunity to buy more at the algo indicated price. So this is a daily chart we have here. The way the algo works actually is off of an hourly. Sorry, excuse me. I'm trying to adjust the. Okay, there we go. So what it does is it measures the distance between the moving average and the low, and the moving average and the high. It looks for patterns, and then when it finds a pattern that is relatively reliable, it either buys or sells. So it bought here, thinking that in the past buying at that relationship to simple moving average resulted in a profitable trade. And as often happens, it continues to decline. And you can see it over here in March. Although in that case it was able to sell at a profit because the stock actually bounced fairly rapidly above the moving average. But here, for instance, it bought, stock rose, but not enough, and then it bought again, and ultimately was able to sell at a reasonable profit. I guess in this case, 18% or 17% or something like that. Looking at the two numbers, 531 and 597. And then down here, of course, it bought at 541 and sold at 609. So it bought at 586 and is looking for an opportunity to buy some more at 525. So let's look quickly at the fundamentals of Bio-Rad. This is the summary report. I produced it today on the 6 companies closest to their buy at or sell at. I don't believe this is any longer in the within the, yeah, it's number 2 now. Okay, it's bounced around a little today. As I said, I've done a bunch of these recordings, and every time I do one, everything changes around and becomes out of date. But anyway, that's fine. That's fine. That's life in the market. If you want stability and consistency, you go to work for the post office, right? So, well, maybe that's not true anymore either. But anyway, let's take a look at the fundamentals here. Bio-Rad, this is the summary report. Three graphs, conclusions down the left side, free cash flow, return on assets, financial strength, and price versus estimated intrinsic value. What's going on with this company is it's hugely profitable, 37% ownership of Sartorius AG, a German company, and the market's basically looking at it and saying, yeah, everything's great, but it may not always be great. Sartorius is trading at a huge PE ratio, and that may or may not last. So we're going to give Bio-Rad some credit, but we're not going to give it all the credit. I mean, I imagine that's what the market's thinking, assuming it's rational. It's often not that rational. But in any event, to learn more, you just click on the ticker, and it takes you to a 11-page report. This looks at 5-year trends, free cash flow, return on assets. You see that since the end of 2019, the company has taken the free cash flow, which is based in part on Sartorius's earnings. Even though it is a non-controlled position, they apparently have no active role in policy or anything else there. You see revenues relatively flat. I mean, they're up a little here. This is COVID, I imagine, in here. And then free cash flow skyrocketing. This is the long-term chart. A pretty up and down company. But these are this is the annual financial statement trends in numbers. Here are the quarterly trends. Down the right side, brief conclusions, improving or deteriorating. Here, return on assets, which are, of course, a product of margins and asset turnover. Asset turnover trend very adverse. Margin trends hugely positive. That's Sartorius again. No debt. Capital expenditures down. Free cash flow up. That means that translates into high quality earnings. Only superior companies can grow without adding debt or capital expenditures. Mostly what I work on off of is free cash flow, but this is net income, pre-tax net income. I use pre-tax rather than after-tax because recent tax code changes, or a couple of years ago, tax code changes started to really skew results in a lot of different companies. and I mean, one element was reduced corporate income tax, another was repatriation of foreign assets. That meant huge tax payments in some cases. Procter and Gamble comes to mind, and then recapture of deferred taxes in marginal companies. So we're trying to understand how the business is doing, and pre-tax is a lot more indicative than is after-tax. So here we have financial strength, general upward trend, and here we have price versus intrinsic value. Again, this is all about Sartorius, and a huge discount to estimated intrinsic value. The market seems to be saying that's not real. And then finally, the summary report, which I showed you a few minutes ago. The thing that's really amazed me over the years of working with this is the value of this middle graph. I didn't really, that was more a risk control measure when I originally designed this software, but it's proven to be an exceptional indicator of future stock price. And I originally thought that free cash flow would be the best predictor, and it's good. It's good. And of course, free cash flow definitely affects financial strength, but it reminds me of that Walter Wriston quote, something to the effect that money flows where it's needed and stays where it's treated well. And this is indicative of a situation where capital is treated well. So Bio-Rad, some risk related to its Sartorius investment, but that's also its real upside. And I think it's an interesting situation and definitely worth accumulating on weakness. So that takes care of the first company in our potential positions watch list. In terms of proximity to indicated buy-at price, now 7.9%. And now we're going to, we'll take a look at Neocrene Biosciences. They have a variety of therapies for different medical ailments and conditions, Parkinson's, etc., all described here under competitive position in the subscribers portfolio report. And it's trading at 11% above. So I'll just be very brief on this one. 11% is enough of I'm sorry, excuse me. It is 11, but it's over here in the percent above buy-at. And you can also access these reports that I was showing you on Bio-Rad. You can simply just click on the company name in the subscriber report, and it takes you to the 11-page detailed report. I'll just quickly go through it here. You see free cash flow up substantially and then down. These little growth companies, or growth companies in general, they tend to have pretty volatile free cash flow. In this case, operating free cash flow trend, is at least stable, but per share weak. That suggests the company's issuing a lot of stock for something, probably for an acquisition for that big. I mean, it'd be pretty distressing if that was options issued to management. I doubt it is, because it would be reflected in this line here as well. Okay, no debt and no dividends, so that makes that irrelevant. Long-term chart, again, a company that just only since 2018 has been generating any free cash flow at all. Our estimate of intrinsic value is heavily dependent on free cash flow. So when a company doesn't generate any, we just estimate the net asset value at zero. not entirely. It's a little conservative, but we we don't like companies that don't generate free cash flow. That's the whole purpose. Owner earnings. You know, companies like Tesla and Shopify. You know, very successful growth investors invest in these, but it's not our strength. So we've made money in them sometimes, we lost money in them sometimes, more recently lost money, and I've just decided not to mess with them. Okay, here we have return on assets trend, fairly strong, although you know uh, declining revenue turnover, volatile margins. It's a bet on the future, but it's a bet on a company with financial uh, strong financial condition. And while I think of it, if you hear someone snoring in the background, that's my old dog Fozzie Bear, 13 years old, barely hanging on, but she sleeps 23 hours a day. All right. Get down here, strong financial strength trend. I'm interested. This is a stock I buy on weakness. And here, we'll take a look at the excuse me. So we bought after a significant decline. Again, the stock declined further. It's up 0.5% today. We'll buy more at 85.31. I think that's still current. Let's take a look. This is updated it's now saying 82.51. So this buy at level, which is updated throughout the trading day, let's say 83.11, I think. 82.51. Okay. 82.51. That's where we buy now, should such an opportunity present itself. So we bought at 95. We're down a little. Good company. It's just a matter of time, I think, before this turns into a profitable position. And now we'll take a look at the next one on the list, Vertex. I've been in and out of that over the last few years a number of times. Great company, creates a drug primarily for cystic fibrosis. It cures cystic fibrosis, but it costs over $300,000 per patient per year. People are worried about Biden and controls on drug prices. And, I don't know. I think that if they cut their price in half, they might have twice as many patients. It probably costs them next to nothing to produce. All the cost is in the development. But in any event, whatever it is or isn't, it's a stock we'll buy on weakness. We'll buy it at 190.92. It's currently trading at 213, roughly. Let's see here. Vertex. Got to change the screen here again. There we go. Except I'm in the way. Anyway, here, well, I guess I just have to move it over more. Yeah, so we don't have a position right now. We bought it, I think we bought it down here and we sold it up here somewhere, and now we're looking for an opportunity to buy again. And but it's got a ways to go. It needs to fall 10% or 11.65% right there. Okay, so now let's take a look at some of our existing positions that we're waiting for an opportunity to either add to or sell. And here in the Progressive Insurance is apparently the company closest to its indicated sell-at price. This is a company that no longer meets the super growth multi-bagger criteria, which I've recently set at a minimum estimated potential appreciation per year over the next 5 years of 30%. And this one comes in somewhere 22, 23%. And it's a big company. It's very stable, it's very profitable, nice rate of growth, but it's just not, it doesn't have the exciting upside that I'm looking for. So given an opportunity to sell at a good price, I'm going to take it. And that price currently is trading at 92.12. We'll sell it at 95.13, so $3 more. Our position cost an average around 87.61, so we've got like 550 profit in there, not much. We're up 5%. Owned it for a couple months. You know, it's fine. It's good. It's a good company. I'm comfortable owning it. I just think that there are better opportunities out there, and you know, we can take a very quick look here at the fundamentals. These are the fundamentals. You know, strong free cash flow growth. It's really benefited from COVID because people are driving less and getting into less accidents. And although they've reduced their revenues as a result, I think they gave rebates to drivers. And here you see 5-year revenue growth, 5-year gross profit growth. Free cash flow growth is much more significant. You know, they've benefited from COVID, but, you know, who knows how long that's going to continue. And here we have dividends versus debt, dividends versus free cash flow. And, you know, dividend secure, 5.4% a year. A good investment for most people. I just want explosive upside, and I don't see it in this stock now. You know, again, trailing 12-month return on assets by free cash flow, 33%, 50% above the average super growth multi-bagger. Latest change, 13%, average super growth multi-bagger, 41%. You know, I think that's where the action is, you know, but this is a game of nothing is what it seems, you know, and you just have to be comfortable with that, right? You can't, this is not, at least the way I invest, this is not about stability and consistency as much as it is huge upside. Stock price trading at $90, I think it's worth 108. Good value. Intrinsic value has grown at about 27% a year over the last 5 years. I don't know why I said no value there. I'll have to take a look at that. Something's not right there. But and then we come down here to the summary report, and once again, free cash flow, financial strength exceptional, trend strong, and you know, great company, just not the big upside. Let's take a look here at this. See what this is all about. We bought it there, bought it there. The sell at was like, I think, averaged around 102 when it was up here, so never quite hit the sell at. It got to a high here of 97.23, it says, 97.85, and it fell again. We bought some more, and we're waiting for an opportunity to sell. Right now, the sell at is it 99.85? Let's take a look. 95.13. Just change this here. You know, it gets up around that $95, we're out. In the meantime, I'm happy to hold it. Good company. Oh, excuse me. We gotta move this over here again. All right. So that's pretty much it for today, I think. Maybe I'll talk just for a moment. Well, St. Joe, we've owned that for a few days. We bought it at stock was weak a few days ago. We took we took a tiny 1% position in it, 1% of portfolio. We bought it at $45, trading at 49. We're looking for an opportunity to get out around 51. It's a couple more dollars. Yeah, good company, owns a lot of land in Florida. It just doesn't have the major upside that we're looking for. And then cell tower, you know, beneficiary of Wi-Fi and 5G, SBAC, sell at 262. I think we're underwater on this one. What do we buy it at? 273, 262. Average price 266, now trading at 250. We're waiting for an opportunity to get out at the algo indicated 262, which is roughly slightly below $4 below our break even. You know, it's a good company. It again doesn't have that tremendous upside that we're looking for, so we're looking for an opportunity to get out. And I'll just talk a little, I think, about, let's see what we've got here. So the algo, it's essentially looking for relationships to this red line, but in reality, it's working off of much more precise numbers. You'll even at times see buys and sells that don't appear to have any real relationship to the red line because we're using, as I said, precise numbers. But the basic theory is when it gets to an inordinate level below the red line and has repeatedly done that, it's a buy. And when it gets to an inordinately high level versus the red line and has repeatedly done that and fallen, it's a sell. So the algo looks for patterns that repeat and then tries to take advantage of them. It's all about probabilities. It doesn't really predict what the price is going to be next. It's like blackjack. You know, the dealer doesn't think, well, you know, I just drew 2 jacks in a row, so the next one's probably an ace or a 2 or a 5. The blackjack dealer thinks, okay, well, what are the probabilities over the next 1,000 cards that the next one will be, you know, a profitable trade? And whatever the probabilities are, that's how it works. You know, it takes advantage of the probabilities over large numbers of trades. And that's how this algo works. It's not predicting what's going to happen next. It's predicting, on average, what generally happens over large numbers of trades. And the way the algo works, it's looking at the last 12 months. So, you know, it's looking for patterns that repeat fairly reliably over the last 12 months and then tries to take advantage. And obviously, any rapid decline, it's trying to sell, and any rapid rise, it's looking for an opportunity to buy. And over the last few weeks, as the market, you know, kind of rotated from growth to oil and banking stocks, interest rate sensitive companies that benefit from higher interest rates, you know, I've made the algo more reluctant to buy, and you know, and so I've dropped the bid basically, and that means the very real possibility of fewer opportunities and definitely statistically less profit potential, but it's more cautious. It's taking a more cautious view. The market's very high, interest rates are very low, inordinately low, and it's a bet how long it's going to continue. Probably it's going to continue for a while. There's all kinds of reasons for that, but in any event, that's how the algo works, and that's probably a good place to call it quits for today. I guess this has taken half an hour. There's probably 15 minutes of interesting information in there. I'll make future ones shorter, and thank you again for your interest in the work.